Hello and good morning, everyone. Thank you for those who are joining in the room and also on the live stream. My name is Mehreen. I write about economics for the Times of London, and I'm delighted you're all able to join us this morning for a start of a busy Davos week to talk about private credit and the private credit markets. This is a topic which I will admit that if I was here at the forum last year, I don't think we even had a session on private credit, and if there was one, I probably wouldn't have been there. So when there is a journalist getting interested in this part of the world, then maybe you know that it's become a bit more interesting, maybe too interesting for people who are practitioners in the sector. But I mean, we're all here to talk about, well, the title is the resilience of the sector. So we're going to be looking back at what happened in 2025 and also forward into 26 and where we are at the state of the market. The private credit market has ballooned over the last decade. Assets in the sector are projected to reach about $30 trillion by the end of the decade. One of the reasons that journalists have become a bit more interested is because of some of the events that we saw happen last year, most notably with First Brands and Tricolor. Those are incidents that we're going to be talking about. I was in Washington in October when Jamie Dimon made his remark about the cockroaches, which is quoted in every single story that any journalist now writes about the private credit market, the fact that there might be more cockroaches to be uncovered. Let's see. We're still a couple of months on after those remarks, and I think it'll be great to get the thoughts of our panelists on Jamie Dimon's remarks, but also where they see the state of the market going into the year. I'm delighted to have a fantastic panel who's going to be talking about the resilience of the sector. I will introduce everyone in no particular order, but I'll start from the furthest away from me. We have Stephen Tananbaum, who's founder, managing partner and chief investment officer at Goldtree Asset Management. Next to Stephen, we have Joe Taylor, who's president and chief executive officer of the Ontario Teachers Pension Plan in Canada. Next to Joe, we have Martina, who's President and Chief Executive Officer at S&P Global. And next to me, we have Christophe de Vusser, who's Worldwide Managing Partner at Bain & Company, not Capital. I got it correct. Maybe we can just start with actually just where we are right now and how we got here. Christophe, let me start with you. I mean, for those of us who are starting to understand and think about the private credit market and where it's come from, where has it come from? How have we got to where we are in 2026? And then maybe just give us sort of the lay of the land as we kick off the year about where you think we might be going.
Yeah, I think a lot of attention is actually on the recent dynamics, but we like to take a longer-term view of what happened over the last 10, 15 years. Because ultimately the growth of the private credit market started after the global financial crisis. It really took up. It existed beforehand, but due to changes in the regulation and the actually uneconomic new regulation that existed for the banks to participate in certain parts of the private credit market, private credit stepped in. Private credit stepped in direct lending and in other credit solutions to the industry because of the bank stepping out. And that actually was the start of the core driver of the growth. And what we've seen over the last 15 years is an industry that has been growing for pretty much every single year, double digit. The direct lending part has actually been growing 20% per year since the global financial crisis. And it started partially driven by the regulation, but then you could see that there was a whole series of drivers that accelerated that growth. The first one is interest rates were low, people were looking for yields. Insurers liked cash returning, longer dated assets, and it was actually attractive for them on their balance sheets. We've seen an incredible inflow also from high net worth individuals, retail health, that started to invest in private equity and then private credit. If you look at it from the borrower side, they actually liked, because direct lending with private credit is often an easy solution. It goes faster, so you don't have to go through the syndication, etc. And then there was quite a bit of innovation, because you talk about 35 trillion market, but there's so many subcomponents that exist now in the private credit market that go from the direct lending to the mezzanine, asset-backed financing, etc. And so even if you talk about private credit, there's no such thing almost as a private credit market. It has so many different components that we can talk about that, because I think it's one of the drivers why this market is also more resilient. And so you look into that, innovation, regulation, and supply and demand drivers that actually have driven an incredibly attractive market over the last decade.
So we have a supply element and a demand element and a sort of regulatory environment, which is sort of perfect constellation.
Combined with the innovation on top.
How we got here. Martina, tell us about, I think often when we're talking about a sector which for the neophyte is quite Byzantine, quite complicated, and often we use terms like high yield and reasonably high risk. Is this how you see it at S&P Global, that we're still dealing with a universe of lenders and borrowers that kind of exist outside the more sort of conventional public markets?
That's a great question, and I would maybe echo some of the thoughts that that Christophe mentioned as well. So we would see that the asset class itself has matured quite a bit. So, from the sort of early days, if you like, of really filling that gap with small and mid-sized companies, all the way to very large investment grade, and it is now, truly multi-asset class, direct lending, asset-backed finance. We've also seen a very large uptick in interest with digital infrastructure and data centers, for example. And so the asset class itself has grown, and I think I like this point about, is there really a private credit market? There is, but it is an interesting complement to the public markets. And one of the points that we've been paying attention to, which is quite interesting, is the movement back and forth between public and private. And this sort of gets to the point of your question, which is it's not companies that sit outside the public sphere. It really is companies who will take advantage, depending on their objectives as an issuer, whether it's timeline, rates, certainty, et cetera, to tap the private markets or the public markets. And so in 2025, almost 2x the volume of issuers refinanced from private to public, for example, than those who refinanced from public to private. And
why would you do it that way around?
So there are all kinds of things. It's not necessarily, in one instance, when we saw spreads tightening dramatically over the last several years, it was really to take advantage of the really tight spreads. It's really for many different things, including, is it certainty, is it timing, is it, how long you want to be, working with a specific sponsor, for example. And so it can be many things, and I think issuers we're seeing now are getting quite sophisticated around it. Maybe the only other point that I would make that hasn't been covered so far is the regionalization and regional growth. So the U.S., as many of you know, has dominated over several years, but in 2025, the U.S. was actually just under 30% of fundraising. Europe and multi-region strategies were actually more than 70% of the fundraising. We see that as a continuing trend, both for diversification outside the U.S., but also for Alpha. And so just a couple of the observations, kind of like how we got to here, if you like.
Thank you. Joe, how much does the private credit market make up of what you do at the pension plan?
Our portfolio is around 35 billion Canadian. We're talking Canadian dollars, so you'll have to do your own currency translation. Apologies. About sort of 275, 280 billion that we have in the fund. So it's probably worth maybe just a slight digression. For a pension fund, why would you want to have credit? I suppose could be one question. And for us, it's actually a way of getting sort of fairly stable risk-adjusted returns, where the challenge, if anything, is how long you have it invested, because it's quite often refinanced, more so than equity in our book. So it's a little bit more liquid, but it's also, you have to work harder to keep that portfolio fed. Our appetite for credit is in some degree relative to our appetite for equity in private companies. So if we look at business and say, you don't fancy the equity part so much, we might move into the credit opportunity as an alternative. But overall, we got our own team, so we very much try to, as we do in equities, do our own due diligence on the business, back to the cockroaches question. And, really the mantra is know what you own. So we don't really have a target number. If we like an opportunity to invest, we'll take it on. I think the geographic question is a really interesting one, in that I think there's, to us, seemingly a bit more demand now coming out of Europe for credit in some of the countries which historically didn't do quite as much as that in an organised fashion. So that, I think, is potentially an opportunity for international investors to look there. I think the other one is, really figuring out what is the rate of return you need to make it make sense in your portfolio mix overall. So for us, we have very long-term liabilities. We want to make sure that on an every year basis we're making a return of 4-ish% above inflation. And credit's quite attractive in that, if we can get low teens yields, that's actually quite good on a risk-return basis within our overall portfolio.
In a world where obviously we have lower inflation and lower borrowing costs in Europe, and also now heading that way in the US, you're still confident about the low teens? Like that's a sort of a comfortable area of returns, and if it dips into single digits, do you become a bit more squeamish about just being involved at all?
It's really where it ranks in the stack of risk. So we do higher risk opportunities, and we're happy to do that. So I think credit really spans anywhere between about sort of 8-9% and low teens at the moment. So you can have a bit of both. I would say that there's nothing wrong in being in the senior slice of a credit opportunity as well, particularly if you look at the returns we need to make overall. That actually sits quite well still for us beneath our equity activities. So, we're not trying to really push the risk envelope with credit to shoot the lights out. That's not really our approach to how we see it in terms of a relative positioning within our portfolio.
Stephen, do you want to give us your outlook and maybe some comments on what you might have heard as well?
Sure. I guess first, with what was said on just the growth of the asset classes grow because they work. So when you're looking at returns of 9 to 10%, which was what happened pretty much the first few years after the GFC, it worked, and there was a lot of good innovation. And so, surprise, surprise, it brought in a lot of capital. And a lot of the innovation that initially occurred, for instance, let's just say technology, which is a big subsector of private credit, whether it was revenue loans opposed to EBITDA loans, became more mainstream in the syndicated market. There was an arbitrage between the rating and the capital raise. And so, for instance, a venture capital firm or early stage investors might give a big valuation of $3, $4, $5 billion, and if they're raising money and they need capital, they may want to take $300 to $500 million in private credit and raise $300 to $500 million in debt. If it has very little revenue and no cash flow, very hard to do that regular way. Private credit market was very open to that, and broadly it worked, and you got paid more. And in general, when these types of deals work and the revenue comes and the EBITDA comes, the covenants get relaxed and there are more buyers, and it goes to the public markets. In terms of, so where are we now? It's we're in the part of the market just taking a step back, kind of mid-cycle. If you look at expectations, broadly is for growth this year being decent growth and next year being decent growth. Credit tends to not make its coupon or barely make its coupon. So you're in the part of the cycle where credit is more stressed or it's more of a hand-to-hand combat, more bespoke, and you're going to need to try harder and be more resourceful to get better returns.
So you in the sort of life cycle, you think we're mid-cycle, and events last.
Actually, of the economic cycle, in terms of private credit, I don't.
And that's the U.S. economy, sorry, or.
I'd say the U.S. economy, but broadly, if you were to look at some of the growth expectations, but you would say that every year at Davos in January. So
yeah, fair enough. Yeah.
Yeah.
I mean, in terms of what happened last year, who thinks that it's a bit of a tipping point, and maybe if the tide has come in a little bit, it's quite helpful for the maturation of the market, for the dynamics that Stephen was talking about, that lots of people rushed in, and then maybe now we get to a point where maybe if the diligence standards were dropping, that people becoming a bit more, they're applying more scrutiny, which should have been happening anyway.
So when you open up the comment or your remarks on First Brands.
Yeah.
And First Brands was a fraud, and then there was a debtor in possession that goes bankrupt the company, and then they need capital to continue to operate. And the fraud, people didn't appreciate how broad it was and the amount of capital needed. So it's unusual when you have a debtor in possession financing, which historically has been a good neighborhood to be in, and it was a terrible investment. The dip went from 100 cents to around 20 cents in about 3 months. So as a result, and it was several $billion, people more concerned about that space, and there's been a sell-off in that space. You take something like Saks, which just did a debtor in possession financing, which priced around 20%. So people are very concerned. It's almost like the mirror image. So I think that market's backed up. It reminds me of what happened with junior capital of banks after Credit Suisse was bought by UBS. And it turned to be very quickly, went from maybe fully priced to very underpriced. And I think that's happening at that part of the market, the debtor in possession. The super senior part of the LME structures also, I think, are attractive as a result of what happened with First Brands. And then there goes to the question, well, are there cockroaches there? And you're always going to see frauds. The issue is what percentage of frauds and what's the knock-on effect and leverage. And I'm not terribly concerned. You're going to see a pervasive amount of first brand type of investments, but I'm sure that they'll continue. And if you look at the private credit market, it's somewhat permissive given that there are few holders, so there are less eyes on it. You also tend to have many situations that don't have top 4 accountants.
Is anyone more worried? You know, that maybe this isn't just idiosyncratic and concentrated in a certain part of the market, but there might be some more systemic issues. I mean, you mentioned that there have been less eyes on it. One of the eyes that it's attracting is regulatory eyes. So we hear much more from conventional financial regulators that what they're worried about is the link between private credit and banks, and that's where they have to step in because they have to care about the banking system. I mean, there is much more heat around or noise around from a regulatory side. How do you see it, Martina?
Yeah, I would perhaps I think we have some of the same points of view as Steve mentioned. Look, you take a step back and look at the market and all the parts of the market, obviously identifying and isolating idiosyncratic circumstances such as what Steve described. The default rate that we're seeing right now is around 5%, and we cover thousands of credits using the same methodology for private markets as we do for public markets. And from our perspective, 5% is a little elevated, but it is not at a rate where we would see, we wouldn't necessarily call it a bubble by any stretch. A few other points that I would make, and you talked a little bit about structures and things like that. Our teams are paying very close attention to the interconnectedness in the system. And so we very frequently report out on that. We're also looking at things like PICs, for example, or payment in kind, which, depending on whether it is done via an amendment, for example, could be a sign of potential stress. But the truth of it is, some of the fundamental factors that impact the public markets are going to be the ones that will actually really be the things impacting the private markets. So, for example, our default rates across public and private, we've seen stress in media. We've seen stress in leisure, hotels, restaurants. We've seen stress in autos from tariffs, for example. And so those are the other things that we'll be paying attention to as we think about the overall risk in the sector. And of course, our credit teams publish very frequently on this against our methodologies. Again, I think what's really critical for the perspective of our teams in the rating agency is the use of a consistent methodology to assess risk between the public markets and the private markets.
If I could just add a comment. I don't think the failure rates ticked up so alarmingly across the sector that you would say there's obvious signs of distress yet. You can get a few examples where it's been well commented on. I think the more interesting question is, are you really getting paid for the risk? So as rates tighten up, then you get more into it might be an interesting proposition, but does it actually suit your book in terms of really getting fully reflected in the reward you make on the risk you're taking? And then I think it's really a question of your level of sophistication, how you actually try to assess that, either independently or through the issuer. So there's a huge span of approach to that, so it's quite hard to generalise.
I mean, just on, you mentioned, we'll get to Stephen, but you mentioned, you guys have to do a lot of diligence. Maybe the auditors in the sector are not as much veracity as in public markets. What are the couple of variables or the categories that you guys on Ontario have to say this is something that we like or we don't like, in broad sort of?
Well, the very easy first question is what information you've been given. So if you're not getting given much information, you should probably know this. It probably doesn't meet your normal standard of diligence. There are other very easy questions, which is, tracking the cash. Is it actually making cash? And given how they're arguing the revenues are building. I mean, everyone, probably has a slightly different style in terms of what they think are the key metrics. But, I think for us, we tend to be a little less driven by who else is investing in the business and more by what do we think in terms of the sector it operates in and the quality of the company. And if we're not being offered enough information to be able to satisfy ourselves with that, then we'll probably pass.
Steve?
Sure. We tend to be involved with companies with an enterprise value of about $1 billion, so it's a little higher part of the private credit market. So, so in terms of tracking and information, it tends to be better than some of the smaller companies, but certainly the red flags when things don't add up. And we always ask, if a company is worth several $1 billion, why are they not using a name accounting firm? What's the record of management, and why? And what are the incentives? In terms of just the way setting up the equation before, about the private credit universe, if you have a 5% default rate with, let's just say, a 60-70% severity, so that means you basically lose 70% of your money on a problem situation, then you have to have spreads of approximately 600 to justify a 5% default rate. So you have to kind of be very focused on what type of return you're getting and what's the probability of default. And if the probability of default's like, I think it's going to work, I hope it's going to work, well, you got to get a lot more compensation than, no, I'd be really surprised if this didn't work. So that also comes into, and when you have a more bullish environment like we have now in credit, where spreads are broadly tied to historical norms the last 25, 35 years, you tend to have to be very deliberate in the private market because the spreads aren't justifying the risk.
How do we analyse the political environment in the US and the regulatory, I think, comments made by Scott Besson, who said, he sees the private credit market as a development because we basically overregulated the banks after the GFC. So he clearly sees that maybe, he's a Wall Street guy, so thinks about, what banks are having to undergo. Is there anything that anyone's heard from the administration that could be a game changer for how you think about private credit in the US, Steve? Well,
he's certainly being more permissive in a bunch of ways. Whether it's for consumer protection, whether it's and it ebbs and flows. Credit cards on affordability, which is, I think, going to be a dominant theme in tomorrow's speech. Yeah. And
have you seen it, by the way?
What's that?
The speech. Have you got any exclusives? I don't think you have seen the speech, but sure.
Can't talk about that.
No, you can't.
But affordability, he said he's going to talk about affordability. That's a theme, and how it goes into banking. How can you reduce what consumers pay? Now, on the credit card caps, on the surface, it looks like the subprime holders are going to be the losers, but my guess is that that's where it ends up. So there's going to be, whether it's energy prices, and energy is a big part of the private credit market, particularly when there's certain it's a big part of the private credit market. And then you look at housing, another also a big part of the credit market. And so what their policies to improve affordability, and then what the impact is on profits. If you're trying to improve the velocity of housing, then if you're a supplier to housing, you're going to be a beneficiary. So there are going to be winners and losers as a result of this affordability theme. The affordability theme is going to be a bipartisan issue in the U.S., and you've seen it already on both sides.
Does the administration's kind of permissibility actually run counter to what we were talking about, which is actually the sector needs to tighten up a little bit on its own standards? Is there an interaction between the political environment, or actually are people in the market still going to be, whatever the administration says, there's a bit more of a heightened sense of standards that need to be applied?
I think it's much more supply and demand driven, if I'm being honest. When everybody thinks there's money to be made, money comes into the market, things tend to ease up in terms of covenants, your controls that you have. I think that's much more of a signal to me in terms of the environment you operate within in credit than regulation or sort of top-down implications. I mean, some good comments made about what the President said so far in terms of what he's thinking. There's a long way to go before that really hits the road in terms of activity. And look, I think there's always the opportunity to pause. You don't have to keep on providing capital if you think that actually things are going against you. I think as you probably have people who feel it's a good market to enter and very enthusiastic to try out some things. That's probably the people who might be a little bit more at risk than people who've been operating there for a long period of time with established relationships and established ways of actually sort of figuring out where it fits into your building out your portfolio. The other one, which I think always is an interesting question for me, is the mix of essentially ETF-driven public funds and institutional capital going into the sector, because they're driven by very different motivations, I'd say.
Christophe, you mentioned the retail investor and the high net worth individual. Is this still, is this a global phenomenon, or is it still regional to the US? We mentioned a little bit about Europe.
This is increasingly a global phenomenon because, of course, you have the retail wealth sitting across the world, increasingly in Asia, there's parts in Europe, of course, in the United States. I think if we see particular events, sometimes we like to make the comparison between the private credit market and the private equity market, because there's always been events in the private equity market as well. And all of the themes that have been discussed have been played out there. People can pause. There's always events that get exaggerated. There's always people that say now it's the end of the private equity market. And then there's the innovation of the industry, and as well increasingly the consolidation of the industry that drives that the industry matures. If you see the alternative asset managers that are investing in private credit now, the last 3 years there's been an incredible consolidation towards the main players. And that also drives the maturity and the professionalism of the industry. And then you can start to see, okay, where is the bigger risk in which type of asset class? Maybe more in certain parts of the asset-backed finance versus the direct lending. And so you need to do your diligence. As was said, the honest liquidity planning, leverage ratios, the underlying industries, which is also a parallel where the private equity industry had to go through, because you play at slightly more junior levels in the industry. But ultimately, we believe that an industry like the private credit, with all its subsegments, where the duration of the investor, you have duration matching and you have risk matching, it should be a safer environment to operate in. Because ultimately, if you think through the banking system, there's almost the ultimate mismatch on duration for short-term deposits that you can get every single day versus the duration of credit. And that is what's driving a bigger risk. Now, the banks are sitting at the more senior side. The private credit sits typically at the more junior side and has its better matching of duration versus risk. So we believe that actually an industry, and then I don't comment on the cross-holding and the crossovers, an industry where you can have this matching of duration and risk on both sides is actually a safer place to play in for investors. And that's also why we think more consolidation around the big household names, more maturity, diligence, understanding of the industry, and therefore also more interest from, certain investor segments that understand that base. So from that point of view, yes, there's always going to be events, but we think it actually creates almost a safer environment if that matching happens of duration and of risk.
I mean, I would maybe just add it. I think it was very well said. Maybe just one slight kind of clarification, at least from our perspective, around increased allocations to the asset class and the risk of, if you have more money coming in, that standards will weaken. We actually have seen something quite different to that, which is, as the asset class became more mainstream with allocators, kind of post-2022, we actually had a number of sponsors, and these would be, the larger sponsors, more professionalized, but also, accounting for the vast majority of the market, actually come and say, look, our, institutional investors and asset owners are essentially demanding credit rating, because if they're going to allocate more, they want to be able to make sure that they can actually, benchmark the risk against other exposures they have in their portfolios. And so, I do think it's important to acknowledge that, there is that understanding of the risk. To your point around changes in, if it's in the U.S., for example, around the admission of private markets, portfolios and opportunities into 401ks and retail funds. I think that's where, there's more education, awareness, and, the types of opportunities for investment that are simple to understand, particularly for retail investors. And, this is where, let's say, index diversification becomes an opportunity, or, the need for more data at a granular level, and that data transparency becomes really critical for, family offices and others, maybe at the asset level or the deal level. And, our view is, from an S&P perspective, we aim to solve that transparency gap with, with what we do across the spectrum. But that's I think where there will be a real need for that education and understanding of the asset class, because once you get out of the realm of sophisticated institutional investors, you have to make sure that investors understand the risk.
We had some figures, I think, for 25 that around 7 trillion of money was taken out of by private credit investors, but all of those redemptions, it seems, were met. So there was, that money was withdrawn. Are we half glass empty or full on that, in the sense that if they were met, that's probably a sign of confidence, that people probably be like, there wasn't any problems involved, or the 7 trillion is a higher figure that makes people think that, well, perhaps something is turning in the market? How do we read that particular single data point, as my editors like to call it?
I think you have to ask why. I mean, some of that could have been geographical diversification in terms of, perhaps more non-US exposure. So I don't think it's necessarily a reflection of the asset class, but we're keen to get your views as well.
I think the other thing I'd say is that the area we haven't talked about at all so far, which I think is still a pretty stable influence and driver of more demand in the sector, is the insurance industry. Mm-hmm. And they're very keen to actually acquire senior exposure to this type of asset class. And I think that's growing rather than abating. The problem with the single data point is, it's hard to really read a lot into it, I would say. So it's probably a bit of both, back to your question you posed. Yep. I think the key point is it was just a one-off rather than a continued run in terms of...
It was a fourth quarter figure, yeah.
Yep.
So a couple of things. Because the market's growing, the numbers will seem large. Mm-hmm. For credit to have poor returns, you need a poor economy. And so I think in the absolute... that you'll probably have more redemptions when there's concerns about the economy, or concerns about transparency and pricing, or the returns I'm being told really the returns I'm getting. Mm-hmm. I think that's going to be an issue. You see it already on the BDCs and the comments on the BDCs that are public. Are they marked correctly, transparency, et cetera. That's why, broadly speaking, most of them trade at significant discounts at 10% or more. Or were trading that a couple weeks ago when I last checked. So, that's the on the state of play in terms of that number. The market's growing, and I think as long as the returns continue to give a premium to high yield, I think they'll be, it'll be somewhat measured.
Maybe I'll give you time to, I'll throw it out there, but is the US economy incredibly strong or actually is it incredibly weak? But I'll let that marinate because we'll go to take some questions from the audience. We have a mic as well. So we have, the lady at the front. Let's know who you are as well.
Hello?
Yeah, we can hear
Hi,
you.
good morning, thank you. My name is Anulika Malomo, and I am an investor, a private markets investor, and a board member. So a number of trends I'm seeing in my world, and I'd love to get your take on if we should be concerned about any of these trends or at least paying increased attention to these trends. So number one, private companies are staying private for longer. And that coupled with a need for distributions for LPs means that you're thinking about innovative ways to get distributions to your LPs. That then lends itself to maybe credit markets, CVs, and secondary strategies. You're seeing more private equity funds launching private credit funds. And you might see that as a good thing because if you're looking at the capital stack, if you know the company quite well, why not just invest in another part of the structure? Perhaps get paid more for taking in some junior risk. The third then will be, as you say, Joe, insurance companies increasingly being owned or private credit funds taking stakes in those. I'm looking at all of these trends and thinking, should we be paying increased attention to them or should we be increasingly concerned about some of these trends?
I'm sure. So probably the most frequent call that people in the private credit market make to sponsors are on situations that are working. We want to help you monetize, and we know you need to get money out. That is the most frequent call, and we make it. I'm sure Joe makes it. Everybody makes it. And so I think that's a good conversation. It provides flexibility, and there is a real issue about giving money back. I would add that probably there's been an innovation in the last few years that's been gaining momentum that I think is a real interesting one, which is a convertible preferred, where you get a multiple of the IPO. So basically, I think that's going to be an interesting option because it validates for the sponsor potentially what the value is, and also this isn't a boilerplate transaction. If in order to make your returns, you really have to believe in the value that they believe in. So I think that's kind of an interesting part of the market that I expect to grow. That was kind of my what I wanted to comment on. I know that you had several questions or several comments in terms of private credit or private equity getting to private credit. I think it's all the boundaries are merging and or blurring, I should say, and I think that's natural. I think there just becomes to do you have the infrastructure, and also do you have the infrastructure and scale? But I think it's natural, and I think it's welcome if they if people give a serious effort for it.
Christophe, do you want to come in on the point about not just, obviously you mentioned the comparisons between private equity and private credit, but there is a massive interconnectedness. Is there a degree to which the private credit market can sort of ride on the coattails of private equity in terms of reputation and maturity of the market? And is that a sensible thing, or should there still be a bit more of a differentiation?
Yeah, I think it's a trend that we see clearly because there's a set of brand names that start to exist in the alternative asset classes where money is flowing because of the confidence of the high net worth, and those brand names are also doing the consolidation with some of the insurance platforms. And so that is an intersection which drives more knowledge, more maturity, etc. One of the trends that we're watching is if you take a forward look on credit markets, we believe they're coming out of a period of capital superabundance. We see actually a churn in how capital will be more rational and rationalized, we think, in the future, because in a lot of the world we're going to go from saver to spender societies because we have demographics that are aging, and if a world is deglobalizing, you have less capital flows around the world from the exporters investing back. And how to think about private credit strategies in the future in a world where you go from superabundance to rationalization, and the strategies you will apply for that is one of the elements that we consider for sure towards the back end of the loans. How is it going to be refinanced, and what solutions? Is it secondaries, etc.? And that is a fundamental shift that's not going to play out in 1 or 2 years. That's a shift that's going to play out for the coming 5 to 10 years. But given the duration of some of those elements, we think it's worth to watch the churn that is happening from capital superabundance to a more rationalized.
I'm glad we got mention of the trade war, and it wouldn't be a Davos panel if we didn't. Sure, Joe, quickly, and then
just a quick answer to the specific question. I mean, I guess if you're an investor, the period where it's difficult was probably coming out of COVID. So 2020, not a lot happened, and then 2021, the market was very active in highly priced, optimistic businesses, where I think if you were a regular investor in the 21, early 22 period, you got issues. Now, the interesting thing about credit is that an equity question, or is that actually a credit question? Because you could be in the loan to own credit part, where you would actually do quite well by actually businesses having to be recycled more into the debt structure. And I think the reason it's worth mentioning that point is that came at a time where there'd been a long period of very predictable returns and very stable activity, so it felt like a big change. And I think everybody's trying to look at the sort of post-22 era and say, what have we got? And I think to some extent people are still figuring that out. But it's interesting how quickly the market bounces back and the lending starts to be introduced.
I was going to say, in reaction to what Christophe said, if the asset class performs, I'm not concerned it's going to get allocated. So the issue to me is more of the asset class performing than the rationalization of capital. And basically, and I've been doing this for 35 years, and I've been a PM for 35 years, and I've seen that capital follows returns. So if a part of the sector is if one asset class is doing well, it'll go there. And if it stops doing well, it'll leave there. So so I think that I'm not concerned about the health of the industry if the returns are there.
Mm-hmm. Any more questions? I thought I saw a hand, but maybe I didn't.
On another thing on the returns,
Sure.
Right now, compared to private equity, I strongly feel that it's not going to last, and probably private equity should be higher in its form. But right now, it's being close in terms of the return, and it's had better liquidity. So when you have returns that are approximately the same, give or take a couple hundred basis points with better liquidity, that's why private equity sees it as an attractive alternative. The analysis is complementary. So, but I do feel as if that the returns, if the returns can still be at a premium to what high yield has been, and looking close to historical averages of equities and perceived to be higher in the capital structure, that's an attractive place to be.
Maybe we could just end with a sort of note to the non-US, and particularly Europe, which was mentioned as a burgeoning area where we're seeing more. Are we seeing more supply and more demand? And in which kind of sectors? And are the returns, on parity with sort of averages that we're seeing, or are they slightly lower in Europe? I mean, it's generally, we're here in Davos. You'll hear a lot about, the sort of shallower capital markets and how this needs to be a much bigger area for Europe to achieve more of its political goals. Could private credit actually fix some of these problems for European policymakers who can't seem to get it done from a top-down level?
Well, I think there's, from our perspective, there are a lot of ways in which the capital markets can develop, including, developing the securitization market, for example, in Europe. But private credit's been alive and well. It may have been a little bit more skewed towards SMEs, but as I said in my own remarks earlier, we're seeing quite a lot of growth into more of the areas that we've seen in the US. So, is Europe, a year or two behind? Perhaps you could characterize it that way. But there's no question that the diversification into Europe is not just a geographic diversification, it's also for alpha.
If you look at the regulatory arbitrage, where basically the cost of capital for a bank is different than the cost of capital for private credit. And so simplistically, if banks sell off their first loss of a portfolio of assets, they get very good regulatory treatment, and it's also very attractive for investors. So that's been one area, and this has been going on for years. It's not new. And then returning capital from sponsors, or allowing sponsors to return capital, is a theme that's going to only avalanche in Europe.
And if you look into public markets are poor in Europe versus the US. But if you look into private markets have actually performed decently well. If you look into private equity, private credit, there's not that much spread actually, because it's more difficult markets to engage in, country-based markets versus a more transparent US market. And therefore, if you look over the history, actually private markets in Europe have always outperformed public markets in Europe and have been at par often versus private markets in the US. And therefore there's a good attractiveness for people for diversification to allocate their private investments across the regions. And that's something that we've seen over the years.
I think also if you're looking to Europe specifically, I think the really interesting question is Germany. Because actually it will sort of dominate to some extent and lead within Europe, and there's been a history there of essentially more regional lending, and I think that there is a change that we can see happening there, and I think it'll be really quite interesting to see where that goes.
Fantastic. I think we have just about run out of time. That was fascinating. Thank you so much for covering a breadth of topics. It is going to be a very interesting week, and hopefully some of the themes that we've been talking about will pop up again. So my final task is just to say thank you to Steve, Joe, Martina and Christophe, and for you guys for being here, and I wish you a very good rest of the day. Thanks a lot.